Hello there everyone, my name is Thomas Krallo. Welcome to my YouTube channel where we talk all things trading, finances and money in general. Now today a little bit more of a trading related topic, and which in my opinion is one of the most important topics in trading, and that is who survives in trading, making consistent profits over the term of a few years or 10 or 20 years, and who actually loses in trading sooner or later. Now this is a big topic because it's actually quite a few students of mine have asked me this question, so I feel an obligation that I need to address this issue. As we all know, there are different strategies and approaches: day trading, long-term portfolio building, intraday, something in between, and all kinds of markets, futures, options, stocks, ETFs, crypto, bonds, etc. So there is a shit ton of stuff that you can be doing as a trader, and there are a shit ton of products that you can be trading. Now, what is the difference between a successful trader and a losing trader, or a trader who is bound to lose sooner or later? There is a huge difference in terms, as we just spoke about, in terms of different strategies. Of course, those are extremely important. If you're just blindly trusting mathematical indicators, for example, MACD, stochastic, RSI, VWAP and stuff like that, then you're bound to fail sooner or later when your luck actually runs out with those mathematical indicators. But that's a whole another topic that was actually covered in some of the previous videos. And then of course, if you're using something like key market levels and maybe the depth of market, which is level 2 market data, when you can actually see the heart of the market and all the pending orders, the ones that are going to be producing the impulse, the fluctuations in the change from supply to demand and etc. So this is the way to go. This is more realistic, and this is something that has a potential of providing more clear entry points and entry signals, reasons, however you'd like to call it. But then there is also the part which goes beyond all of that, beyond your personal trading algorithms, beyond your approach, the systematic way of approaching the market, meaning your strategy itself. And that is, how flexible you are. So this is the pinnacle, and this is the super important part, which actually stops a lot of traders from making money consistently, and makes some of good traders, actually quite good traders, start losing money and then losing faith in this whole business, and ending up losing quite a lot, and maybe all of what they've made in the past year, 2 or 3 years, or maybe a few months. It really depends. It's always very, very subjective. There is nothing definite in the world of trading. And the reason why this happens to so many good traders is because they are not flexible. If you have some trading experience, you know that the market is always different. It was different yesterday, and it will be different tomorrow. Now, those differences, they can be slight, and they can also be very crucial. Now, for the most part, the market is always the market. The only difference can be the volatility, the volume, how wide the moves are, and these kinds of things that are quite obvious, and they should be in your trading algorithm. You should be always checking them and calculating your chances and etc. However, there are times in the markets, like right now, for example, the COVID. If you look at the charts, and especially if you go back to February and March, when that huge down move began, this is a huge change in the markets. So we are basically in a really strong and a very aggressive bear run. So everybody's super scared, everybody's selling off their stock portfolios, and of course the markets are tanking. So in this kind of a scenario, which it's important to actually emphasize that these kinds of situations and scenarios, they do happen quite often, and they are happening more and more often than, for example, 50 years ago. However, they do not happen every day, they do not happen every month, and they do not happen every year. Of course, if you're looking at certain stocks, then these kinds of fundamentals that we're going to talk about do happen sometimes even on the daily basis, and that means some fundamental news when, for example, Elon Musk tweets that his stock is overpriced, and of course a lot of investors get scared by it and they sell a portion of their stock off, and Tesla stock moves down, but this is something a little bit different. What we are talking about here is more futures trading and the general markets, the indices such as Dow Jones, S&P 500, German DAX, the Chinese SH50, and etc. So these bigger indices and general markets altogether. And of course, it's more relevant to those who are trading futures. And well, stocks as well, but mostly for futures and indices. So in these kinds of super scary times, such as COVID, the market, as I've said before, is in a strong bear run. It's not always, so not at all times. However, there will be days and weeks when the market is just plummeting down. So when you can see that, you cannot really stick to your normal approach, to the normal approach of an everyday market with, usual volatility. You cannot expect to have the same amount of successful trades, long trades, as short trades. So you must change your bias. It's actually quite simple. You have to change your bias from both long and short trade bias to just short trade bias. Sure, some of the long trades are still gonna work for a really small impulse here and there. It's not just, the price isn't just plummeting all the way down, it still is going up and down in waves if you take a look at the smaller time frames. However, long trades in these kinds of scenarios and in these kinds of hysterical, aggressive moments are gonna be a lot more dangerous. Therefore, statistically, it makes perfect sense and it's only logical to remove at least a bigger portion of your potential long trades. And the same thing goes for strong bull runs. However, it's worth noting that in my personal experience and my observations, I can say usually the bull runs are not as strong as the bear runs, especially in the indices. Again, if you're talking about some penny stocks, then when they're pump and dump schemes and all of that, sure, some of the bull runs in those can be just as fast and ridiculous as the bear runs. We are talking about the general spectrum of markets in general in the world, as I've said, S&P 500, Dow Jones, DAX, etc., etc. Why is this important? Because we have to keep our eyes open. As for me, when I am trading, and I haven't really been trading that very much actively recently, but when I was trading very, very actively, then when I would be getting to my trading station once a week, or when I was trading every day, I would be getting to my trading station with a completely clear mind. So I'm not thinking about what happened yesterday or what happened a week before. Sitting at my trading desk, I'm opening all the charts, the trading station is loading, I take a look at my trading algorithm, and then I go through all the markets. I'm pinpointing the areas of interest for me that I would be considering taking trades on, so therefore, planning out my trading day, so to speak. But I wouldn't be looking at it with a perspective of yesterday. I'd be looking at it with a perspective of today. I would be evaluating the ATR, the range, therefore my expectations for any given trades, because the ATR, which is actually quite simple to use, this is the average true range. It's basically, you can set it to the past 14 days, you can set it back to the past 30 days. Since I've been trading very actively with scalp trades and sometimes some swing trades, I'd use just the past 5 days of ATR, which would give me that, in my opinion, the precise and perfect ATR reading that I could use for my expectation formation for any given trades on that specific day. And then I'd be going into the actual trading and opening of the trades, but with the clear view of today. What can I expect today? If I'm looking at the markets and I'm seeing that everything is just in a bear run and everything is dropping like flies, am I gonna be opening long trades? Probably not. If I see that in the longer time frames that the down move is slowing down and we are perhaps going into a small consolidation, or I can see that in the hourly chart or the 4-hour chart, then I would again switch my bias back into both long and short. But if we are just dropping incredibly fast, going down, I would stay away from opening long trades. It actually, if you have some trading experience, this might sound very simple and logical, which it actually is. But a lot of traders make simple mistakes like these, and they end up paying with huge portions of their trading deposits for just not following the logic and not having some common sense. And trading in general is one of those businesses that it's actually quite easy, for some reason, it's quite easy to lose that touch with reality. That is the reason why until this day, if I'm trading, I still keep my clean, understandable trading statistics that I can analyze later, and as well as my trading algorithm, which I can adjust later on. And the purpose of the trading algorithm is to basically looking at everything that you are doing from a systematic point of view. And sometimes, as I've said, you can lose touch with reality when you're trading very actively. And this is partially because of the emotional state of traders. Trading affects you emotionally quite a lot, and you can go a little bit cuckoo sometimes and forget about some of the rules, and that's the reason why you have the trading algorithm and etc. But besides that, besides keeping it all systematic, you also must stay flexible by looking at the markets and understanding the general spectrum of things, the general mood of the market. Where are we at and where are we going in general? Use logic, and this is how it will help you to move into a more statistically probable area and way of trading than if you would be just following blind technical rules all the time. Everything is the same. I'm just trading like that. It's gonna work, and probably it might work for a few years, especially when coronavirus is gonna be over. The markets are gonna return more or less into a stable state, and most of the markets will just enter its usual bull run for simple up move for the next 5 to 10 years before the next crisis happens. Or maybe it's gonna be 5 years, maybe 15 years, but it's gonna be more than a few years. So, and in that period of time, some minor adjustments to your trading algorithm are always necessary. However, you might not expect to change it too drastically. In these kinds of scenarios, with these kinds of strong bear runs, it does make sense to adjust your trading algorithm drastically. However, as I've just said 10 times before, it does not happen that very often, but it does not mean that you shouldn't keep your eyes open. All right, I hope that this makes sense and that I was able to help you in some way. And if you like this video, please hit the like button. If you're not subscribed, subscribe. And thank you for watching. I'll see you in the next videos.